I've got to say, I've never really been a big fan of the covered call strategy. I think we have to consider how the strategy is altering the return generating process relative to a simple buy and hold of the underlying. So what it's doing essentially, if you're unfamiliar with calls, basically what a call is, if you own a call contract, it gives you the right but not the obligation to purchase the underlying asset at a pre-specified strike price. Generally, if you're rational, if a stock is trading above the strike price, then you should exercise that option because you're going to get a better deal exercising that contract. If it's below, you don't have to. You don't have to exercise it. So you have that option. That's why they're called options. What covered call strategists will do is they'll sell the contract. They'll sell the contract to you. And while also holding 100 shares of the underlying asset. So they participate a bit on the upside, but once it reaches above the strike price, they're not participating in it anymore. When it reaches above the strike price, they now have that liability where they need to make the other holder of the contract whole by providing them being able to buy the shares from you at the strike price that you already agreed to sell the contract at. So you're basically truncating the right tail of your return distribution relative to a simple buy and hold. And in my opinion, this has a couple issues, right? So the first one being the right tail has historically been integral in realizing the historical equity risk premium. Just off the bat, we look here through this holding period, a simple buy and hold of the underlying has resulted in a 13.7% compound annual return, whereas the covered call strategy has significantly underperformed 7.4%. And a large part of that is not participating in these large returns in the right tail of the return distribution. Another part of it has to do with the skew of the return. It's very well documented that investors have a preference for skewness. And mechanically, if you're going to truncate the right tail and leave the left tail mostly unaffected, it's slightly improved by the amount of the options premium, but for the most part, it is completely unaffected. Well, you're going to decrease your skew, and it's very well documented that investors love their skew, both theoretically and empirically. We Harvey Siddiq 2002, we got Chabio Crash Factor 2017. Just look at the options markets. Look at the difference in the implied volatility of more out-of-the-money put options. Why would more out-of-the-money put options have higher implied volatilities? Well, that has to do with the hedging preferences of economic agents looking to hedge that left tail risk. But here, because you're retaining the vast majority of the left tail, you completely truncated the right tail. Well, that's going to mechanically decrease your skew, which is exactly what happens here. The third thing I'll say is that stocks exhibit mean reversion. That's a core component of what makes stocks actually safer over the long horizon, because periods of poor performance tend to follow with periods of strong performance. And as we've discussed, by truncating that right tail of the return distribution, there's a chance you might not be participating in those recoveries. And there's other things to consider. I'm not going to talk about them as in depth, but your short delta, when you're short a call, your short delta, which limits your exposure to the equity risk premium. It's tax inefficient. You're realizing a short-term capital gain immediately. You're incurring higher transaction costs, and if you're going through the ETF wrapper like XYLD, you are paying a higher management expense ratio than you otherwise would in just simply buying and holding the underlying SPY, which has minuscule expense ratios. So yeah, that's it. Just a short video saying my opinion on covered calls.